All right, thank you and welcome. My name is David Kinder, and this is my presentation on risk tolerance and capturing, or rather recapturing investment losses. As I was putting this together, um, I really should probably call it Why I Used to Think I Was So Smart, How I Wasn't So Smart, and How I Discovered to Get Smart Again. Just a little bit of humor there, I suppose. But let's take a look at some things here. The first part is some disclosures. The first, I'm no longer registered with FINRA, which is the Financial Regulatory Authority, or the SEC to give advice on securities. So if you have any questions around your specific portfolio, whether to buy, sell, hold, or a general analysis of your holdings, please see a competent investment advisor or registered representative properly licensed in your state. All information shared is for educational purposes only and is taken from sources that are believed to be reliable and available to the public. This presentation is based primarily on my personal experience in advising clients regarding investments in securities, and any rates discussed are for illustration purposes only. Okay, that being said, here's the problem. We all want a greater return on our savings and investment portfolios to have our money work the hardest it can for us. Yet, if we put our capital at risk, we may lose both the value of that capital as well as the time for compounding our wealth. Registered investment advisors, those with a Series 65, they are RIAs or IARs, which is an investment advisor representative for a registered investment advisory firm. Also, registered representatives, those with a Series 6 or a Series 7, we are all not trained to be economists to predict the future. That's not part of our licensing and training. So how do investment professionals give advice? Meet Harry Markowitz. Harry Markowitz won the 1990 Nobel Prize in Economic Sciences. And this was based on his work that he'd been working on for decades on modern portfolio theory. The theory is, by using risk-return statistics, one could do well with their portfolio by picking and sticking to a given risk tolerance parameter. So what does that mean? Well, let's take a look at the risk-return model that he put together. This is the return. We want higher returns. We don't necessarily want risk, but we need to measure that risk. This is compared to a risk-free rate. So if you take no risk, you get no return, you got nothing. Well, that's 0.0. You could also see that as a 0. What we see here is that some people, when you meet with them, they say, I want to take more risk so I can get more return. The far out on the risk curve is this point W. Take a look at that. Compare point W to S. Look how much more risk you're going out on the scale, and yet look at how very little return you're getting compensated for taking that risk. So what is it that we look at as investment professionals? We look at the statistics to figure out how close can we get to this efficient line of balancing risk and return. Look at these other points. Here's 1 unit of risk with 1 unit of return, which is point R. Well, here at point R, this is lower than what we could get for the given amount of risk. So what we really want to do is optimize a portfolio and get closer to Q, as the Q is showing up here. If we could do that, we can earn a higher return for the given level of risk. If we're willing to take on more risk, we don't want to be here at T, we want to be at S. We want to be properly compensated for the risk that we take. That's pretty much it. Anything below this area, I guess, is okay, but we want to really optimize what the best we can do for our clients. Now, that's compared to a risk-free rate, which is basically a savings account or a CD or maybe a money market account at your bank, because there's no risk being taken there. The government prints money, your deposits are insured by the FDIC. That's what I usually look at as a risk-free rate. However, what we also can do is compare it to appropriate benchmarks. So this is a scattergram, and we're comparing risk. Risk is lengthwise, and return is the up and down. And we're comparing a particular fund to the S&P 1500 index. That's what they put there. I just grabbed the picture. And according to this, the risk is a little bit more, but the return has been higher than the benchmark. And that's for a 1-year return ending in December 2013. So when you compare it to appropriate benchmark, you're taking more risk, more return. Now, is it possible Is it possible to take more risk and have less return? Absolutely. Is it possible to have less risk and less return? Absolutely. Is it possible to have less risk and more return? Absolutely. Here's a 5-year example. This one, we're comparing the Eagle Mid-Cap Growth to the Russell 2000 Index. This is showing less risk, less volatility, and a higher return to that benchmark. So one of the things you got to do is make sure the benchmark is an appropriate risk barometer for the client, as well as comparing the fund to that benchmark. Some problems with modern portfolio theory. The first one is that modern portfolio theory assumes that past performance is an indication of future results. Well, no company, no investment fund, not even Morningstar is going to tell you that you can rely on that. Past performance is no guarantee of future results, but modern portfolio theory assumes that what has happened in the past is going to continue as it has, uninterrupted. So it assumes that life continues with no changes. No changes in political, no changes in demographics, no changes in economic policies, no changes in economic indicators, that everything stays as it has been. Unfortunately, reality is different than that. Everything changes. Investment professionals are simply not economists. This is my fun thing. You can get a mouse pads and posters and things from despair.com. Economics, the science of explaining tomorrow why the predictions you made yesterday didn't come true today. It's just the things that happen. Some firms do have in-house economists. So these firms are generally Merrill Lynch, Morgan Stanley, UBS, Edward Jones, Waddell & Reed. There are others. And these firms create their own buying recommendations, selling recommendations, and holding recommendations to their advisors, and generally through newsletters to their clients. If an advisor chooses to stray from the firm's recommendations, that advisor may be held liable for not following the firm's recommendations. So in short, advisors are generally not allowed to have independent thoughts of their own. Okay, so I want that to be very clear. There's some very good firms out there, and there's some very good advisors, but unless they have some specific training and background to give investment recommendations that stray from the firm, they better know exactly what they're talking about, or they can be held liable for those recommendations. Is there any consistency in giving advice? The joke goes like this: why did God create economists? In order to make the weather forecasters look good. Here's another one. What's the difference between an economist and a befuddled old man with Alzheimer's? The economist is the one with the calculator. Alzheimer's is very serious. I apologize for any offense there, but it is kind of interesting that basically economists, we try to look for their opinions, but you ask 20 different economists for their opinion, you're going to get 20 different answers. There's no consistency with following various economists and their opinions. I've never learned how to read economic tea leaves. There's a lot of different economic indicators out there. You've got your new housing constructions. You've got cost of living increases, or rather the CPI index. You've got unemployment factors, assuming that everything's being reported. You have, there's so many other things, but can you take all those factors, try to get a general trend of history, and try to predict what's going to happen? Just because you read about a bunch of economic indicators doesn't mean you can form an educated economic opinion that can be well considered. Now, there is one that I do try to follow, and I don't understand everything on this, but Harry Dent is one who seems to follow demographic spending trends. He follows the baby boomers, he follows Generation X, Generation Y, how they spend their money, and how it affects different things across the globe. He's a brilliant man, not always exactly correct, but his general trends have been spot on. It's one of the things I've noticed about Harry Dent. So I find that there's two main kinds of advisors out there. There's the planning type. The planning type is trying to create synergy with all your money. We want to look at your insurance, your income taxation, your retirement planning, your investments, and your estate planning matters. And our goal is to help you create a weatherproof plan. and it's a life planning focus. So as things change in your life, how do we make changes in your portfolio? How do we make changes in your insurance? How do we make changes in other things as things happen in your life? To me, that's my kind of planning. There's another kind of planner, and it's called the frustrated economist type. This person is always reading the Wall Street Journal and other news every day to always stay on top of economic developments. Not a bad thing. His sales pitch is this: I want you to know that I know what's going on, so you'll trust me with more of your money. Well, that's being an opportunistic type of a person. For me, I'd rather have weatherproof plans, things that can withstand just about anything that can happen. So I'm not an opportunist with people's money. I want to have weatherproof plans that are based on sound foundations. So that's me. Now here's the thing about inquiring about risk tolerance. It's flawed. Okay, I was trained on this. Look, we want a higher return on our money, and we instinctively realize that in order to get those returns, we have to endure some volatility. That's really a pain threshold. How much pain can we withstand? If we could just get 15% returns above the risk-free rate when we do it with zero risk, we'd do it. Of course, that would be called the risk-free rate. But the fact is, according to FINRA's own financial capability study in 2012, this is on page 16 of that, when we think about our financial investments, how willing are we to take risks? Look at that pie. I mean, it's divided up rather interestingly. 35% are not willing to take risks. That's a pretty high number. Notice that in relation to those that are willing, 17% are willing to take risks. That's about double. Most people are not willing to take risks with their money. Now 44% is neutral. 44% is neutral. Now when you're an investment advisor and you're supposed to be determining people's risk tolerance, if someone is not sure, you have to err on the conservative side. You cannot take risks, unreasonable risks with that person's money. You have to be more conservative. Now, one thing I'll just point out here is that it looks like relative to 2009, 12% respondents reported they were willing to take risks, whereas now it's 17%. So between 2009 and 2012, we've seen some uptick in the market, and so more people are willing to take risks. Well, the market's already rebounded. So now we're seeing a trend that people will feel better once the market's back up. Well, that's when they're buying high, and then the market goes down again, they're going to sell low because they don't like the volatility. Something to keep in mind there. So how did I make my recommendations? Well, with some expert help, I came up with a great core portfolio of mutual funds. There were two funds I worked with quite a bit, and this was CAIBX. This is the American Funds Capital Income Builder Class A, and CWGIX, which is Capital World Growth and Income, also from American Funds Class A. These funds were great funds. They both weathered the 2000-2002 dot-com bust very well. They both had great modern portfolio theory statistics through 2007. Now, I'm going to get a little technical here with you, and so I kind of apologize because this is stuff that I need to know, not necessarily the public. But what we want to do is be able to measure risk. And in modern portfolio theory, we talk about risk as beta. And what we're looking for is a risk factor of less than 1. Basically, if an index is 1, we want risk that is less than the index. If we're going to pay for mutual funds, we want to make sure we're getting our money's worth. We don't want to just buy an index fund. You could do that. There's Vanguard and Fidelity and others that have very low cost funds. But if we're going to be paying commissions for funds, we want to make sure we're getting our money's worth. So we're looking for a risk factor that is less than the index, the given benchmark. We do want a return. We want alpha. And if the index is considered 0, we want a return higher than 0. Now this is just a measurement. This is not the actual return. So we're looking if the alpha is 0.5 or the alpha is 1 or the alpha is 2. That's not the return. That's just a factor compared to the index, which is measured at 0. The next part is what we call R squared. R squared measures how much of the fund's returns are attributed just to the market and how much is attributed to management. So if the index is 100, it's measured at 100, then we're looking for funds that have less than 100 because we want the management to actually be contributing to the return of the funds. So as an example, I can't find this, so I'm trying to do this from memory. These two funds had about a 52 R squared and an 85 R squared. Now, Capital Income Builder is primarily a US based domestic fund, primarily, and they can invest up to 25% international, if I remember this correctly. And so they had 48% of the fund's returns came from the managing of the fund. The CWGIX, the Capital World Growth and Income, is primarily an international fund with up to 25% allowed for US domestic investment, and then had a rating of about 85 for that R squared. So you can see we're trying to find the best value of investing without a whole lot of volatility. We want good returns compared to the index. And so I'm looking at those statistics. Now when I meet with somebody on a scale of 1 to 10, what we do is we talk about investment risk tolerance. We talk about a 1 being like a CD and money market. There's no risk, very little return. We talk about 10 being penny stocks. You don't want to put your life savings in penny stocks. You can dabble with that if you'd like. But penny stocks are generally stocks that are valued at under $10 per share, maybe even under $5 per share. You might find some opportunities, but more often than not, that's not going to really help you build wealth long term. That's for the day traders. You can do that if you'd like, but generally, as far as I know, no professional investment advisor is going to recommend you put a significant amount of money into penny stocks. So we have the 1 is CDs, 10 is penny stocks, the 5 is the Standard & Poor's 500. That's the index. Well, most people will gravitate toward the middle when given a range in anything. I do remember one person I sat down with, and he told me that his risk tolerance was an 8. Kind of had to bring him back down a little bit. That's way too high, and I work with more conservative strategies, or at least I try to. So what I tell people is that what if we could give you the returns of a 5 but with the risk of a 3 or a 4? Well, that would sound pretty good, right? You don't want the volatility, but you do want the return. I used to joke with people, hey, what we really want is no risk and 15% returns, right? And they all go, yeah. I said, I don't have that. But when I showed them how these funds looked, I classified one fund as a 3 on this scale, another fund as a 4. Lower volatility but higher returns compared to their benchmark indexes. So let's take a look. This is a screen print from Morningstar. This is the America Fund's Capital Income Builder, and you can't see the range in here, but I do show January 2nd, 2000 through December 30th, 2007. The fund performance is the dark blue line, pretty much at the top. Pretty stable fund. When compared to its benchmark, which is Morningstar's World Allocation and a Morningstar Moderate Target Risk Fund. So they have their own index. Usually it's a blended thing to compare to appropriate benchmarks. This was a great fund, pretty mild, and that's an 8-year period. Not a whole lot of jarring there. It did lose a little bit in 2002. I think it was the most was like 5%. I mean, it didn't lose much at all. And in 2003 came back quite nicely. The expenses were low. This is still rated as a 3-star fund even today. But that was the basis of what I used when I was giving advice. Then look what happened. 2008 happened. Now that was bad for everybody, but notice I was positioning this fund as a moderate fund and a very mild fund. Someone whose risk tolerance wasn't very high, I thought that would be a great fund. Wow, look what happened there. What happened here in 2008, this fund tanked. I mean, there was no history of having this kind of volatility. I mean, everything in the market tanked. But when you're trying to market funds and you're trying to show them an investment strategy that would really feel comfortable for them, and then this happened, it's crazy. Now, look at what happened here. 1, 2, 3, 4, about 5.5 years. 4.5 years to finally break back to where you were. And now finally it's regaining on. But this is a much more jarring picture. But you lost 4.5 years of compounding if that money was kept in a risk-free account. That was not my intention for my clients. I did not intend for that to happen. Now, it wasn't my fault. Government had put these bubbles in place in real estate, in the markets. There's all kinds of stuff going on. We had the AIG, we had Bernie Madoff, we had all this stuff happen. And we can talk about all the different things, but that was a horrible year. Now, I had left my old firm by that time. I started with a new company, and I didn't take any of my old clients with me. And I'm looking at, I'm on my computer at the office, and I'm looking at what Bloomberg is showing, which is a lot of negative days. I'm like, what did I do to these clients? Now, granted, it wasn't my fault, but I still feel bad because you lost the time and you lost the use of your money because you had to leave it in there. And heaven forbid it was somebody that was within a couple of years of retirement. That really puts a devastating blow on their retirement. And so I'm just feeling really bad all over about this, even though I thought I did a great job. So here I thought I was really smart. It turns out, well, I can't predict this. No one could predict it. Well, actually, I think Harry Dent did in his own way, but this was shortchanged a couple of years. Now, this was the International Fund. The International Fund did, again, very well. Low expenses, 3-star fund. The dark blue line here at the top, a little more jarring than the other fund. That's why I classified this as a 4, but did very well compared to its benchmark. Great fund. And then that happened. That wasn't the way the fund was before 2008. And all this happened, much more jarring. And this fund took about 6 years to get back to where it was. Now it's doing better, had a little bit of a dip here. So, oh blank. Insert your favorite expletive here. It took on average 5 to 6 years to get back to where they were, assuming they didn't sell out their holdings or liquidate sequentially for income purposes. Now imagine this, you're in retirement and you want to pull out $30,000 out of your portfolio in 2008 because you need that money to live, and you're pulling out once a year. Well, if you're pulling out $30,000 and the portfolio is down in half, then pulling out that $30,000, what you're liquidating could have been giving you $60,000 of income. You just lost 2 years of income because of 1 year of a down year. I had used modern portfolio theory, past performance statistics to make current investment portfolio recommendations. In using such recommendations, I failed to realize that nothing stays static in the investment world. Even indexes change their holdings on occasion too. So even if you're looking at the Dow Jones has 30 stocks in it. The NASDAQ has 40. The S&P 500, of course, has 500. They change out the companies that trade on their index. So they do that on a semi-regular basis. Not all the time, but they do trade companies out. Past results really are not indications of potential future returns. And markets are generally unpredictable. Markets go up and markets go down. Nick Murray, who's a guy who writes a lot of things for the investment advisor industry, he's a really good training. He called the market manic depressive. If you're not familiar with that term, it really means that the market is insane or crazy. His solution was to make sure you stay invested in a well-constructed portfolio. Well, I thought I did that, and look at what happened. Now, granted, you cannot guarantee against loss, but you didn't think it would go down 30%. So that advice didn't quite work so well for me. Sometimes markets go down when there's good news. Could you imagine that? Well, I found that. There's the link at the bottom there. But April 14th in the year 2000, the Dow dropped 617 points, and that was about little more than 5.5%. The Dow dropped in reaction to a government report that said consumer prices were stronger than expected, which triggered fears of inflation. It's like you're danged if you do it and you're danged if you don't. You can't make anybody happy. But I made my commissions, right? Let me tell you, I did make my commissions. I had a compelling investment philosophy at the time that seemed to be great for my middle income clients. But when all this happened in 2008, this is a 2-month period of all these different declines. For those 2 months, look, I wasn't exactly laughing all the way to the bank. I was like, what did I put my clients through? Now that's a total, you'll see in the red there, negative 56.92%. Now, it didn't end that way for the year. That's just the amount of down days, the biggest down days at that time. But that's over a 2-month period. I'm just thinking about the clients I was working with. I'm like, what on earth did I do to them? I didn't do it, but they're in that position. So I learned a lot of lessons. I got a few pages on this, so stick with me here. So first one is factors beyond our control robbed us of our wealth building potential. Buy and hold may no longer be a sound strategy. Even buy, hold, and pray might not be enough. Investment risks to your principal compound with time. The longer you leave your investment in there to work with for you, the more you have at risk. So let's suppose you started with $100,000, you lose 10%. That's $10,000. Okay, but if that was $250,000 and you lost 10%, that's $25,000. Now everything's relative, but the more you have at risk, the more that the risk, the percentages compound against your entire balance. Part 2. Investment professionals must base their recommendations on a given risk profile with a portfolio allocation constructed based on past performance metrics. I did my job the right way as I was trained to do. This is the way we do it. We are looking at what's in the past, what's the volatility, we're looking at the statistics, we're figuring out what is appropriate for this client that's sitting in front of me based on their goals and their objectives. What is it they want their money to do? You need to make sure it's a comfortable recommendation for them. But yet we're not trained economists. And I really don't know if it's possible to tame an untamable beast. And sometimes I start thinking that the only people that win in selling investments and securities are those that actually sell the investments. I'm not necessarily positive anymore that clients win out. Another page. Mutual funds by law must adhere to the investment strategy found in the prospectus. They cannot deviate from it. If they deviate, it's called a style drift. And every fund does a little bit of that, but it's within the bounds that's set by the prospectus by law. But that's suppose like the Capital World Growth and Income Fund, if they saw this is happening, they can't just liquidate everything and put it to cash. They're not allowed to do that by law. They have to keep the fund style according to the way they've outlined it in the prospectus. They can't make those radical changes. Mutual funds cannot be traded or transacted without specific client authorization. Basically, they're non-discretionary accounts. As an advisor, as an advisor that I was before, I was not allowed to make transactions without the client's approval. So this would require lots of calls to reach clients in order to make emergency reallocations. But imagine, clients are at work. You get their voicemail. They finally call you back the next day. We finally get trade confirmation, we record the conversation, and we get it going. But you can't necessarily do it during the day. Also, mutual funds, the way that they're traded, they finalize their trading. Like if your client wants to liquidate their mutual fund, it's done at the close of that day. It's not done during the day. It's done at the close of the day. But how long would this take? Would it take a month? I mean, if I had 300 clients, for example, and I wanted to make emergency reallocations, how long would it take me to contact them all? Who would be the first person I would call? Well, they would be the lucky one, right? Well, conversely, who'd be the last one? How would I explain that to them that they were the last person I decided to call to try to make a change in their portfolio? Pretty difficult questions that I'd have to answer. You cannot day trade your mutual funds. You cannot reallocate the allocation for at least 30 days, and it's spelled out in the prospectus. So once you've made the allocation, and let's suppose the market is now tanked, you think, great, now let's reallocate and let's take advantage of the upside growth. Well, you can't do that for at least 30 days. And that's spelled out. There are trading restrictions on your mutual funds, so something to keep in mind. Page 4. Do I really want to take on the liability for making investment recommendations knowing what I now know? And that's an internal perspective. And until I find some other ways of managing client risks, I really don't want to do that. Also, the compliance hurdles and the cost of doing business with securities has only gotten more restrictive with higher costs. So do I want to put my clients in there in the first place? And the second part is, do I want to deal with all the bureaucracy and the costs of dealing with the bureaucracy? And generally, as of right now, my answer is no, I really don't want to do that. Is it worth it to be in the securities and investments business if my clients can lose up to 50% of their wealth, especially if that happens within the 5 years before and 5 years after retiring? That is what we call the red zone. That's the part where everything counts, everything matters. You need to secure everything the best you can. Page 5. Reverse dollar cost averaging is the opposite of dollar cost averaging. And I kind of talked about that already. When you're pulling out money out of your portfolio, but it's at half the value, you're taking out twice as much of what it could have been, and it's not going to rebound as quickly. Liquidate portfolio while it's reduced in value will significantly reduce your potential upside as markets rebound. Yes. Your sequence of returns cannot be predicted. We talk about it all the time. There's a lot of industry publications about the sequence of returns, but you can't predict it. I don't think there's any such thing as reasonable volatility anymore, nor can anyone really control it. I used to think that reasonable volatility was generally within 10 percentage points. If you lost 10%, not a big deal. You make that back up the next year or so. But let's take a look at this, the impact of losses. This is an important chart here. This comes from Crestmont Research. And basically what they say is the number one rule of investing is also the second rule. Don't lose. So if you lose 10%, it takes 11% to get back, at least within 1 year. If it takes 2 years, it might take 5.5% per year. You lose 20%, it takes 25% to get back. If you lose 50%, you have to get 100% back. How long is it going to take? Well, the markets had already lost in 2008 about 50%. And as we saw on the graphs of just those two funds, it took about 5 years to get back to where it was. And you lost the compounding, and you lost the value, and you lost the use of your money during that entire time. Heaven forbid you ever get a 90% loss. If you have 90% loss, you have to expect that gain to come back at 900% to get you back to where you were. Probably very unreasonable. But it takes time to get those gains back, to put your money back to where you were. So lesson learned, page 6. Commission quotas create a conflict of interest between the advisor or representative and the client. When I look back and I think of a lot of the investment trades I had done, knowing what I now know, I wouldn't have done about half of them, because you really need to have they needed to have more of a solid foundation of savings, a greater amount, maybe 6 months of emergency savings. At the time, the firm said you need to have at least 10,000 of savings and then invest above that. I really should have had that at a higher level, especially if volatility is going to happen the way it did. But the quota makes the advisor or the representative have a greater duty to their employer over the client. Now, there's been a lot of talk inside our industry that's saying that compensation is the problem. No, I don't think it's compensation. I think that advisors do a good job within the products they have and the licensing they have. I think what it is that if there's a mandate to hit a certain quota by each employer, then you're going to be wanting to make sure you have enough padding within your commission so that if you wanted to refuse some business or do business in a different way, then you could. But if you don't produce enough to meet your quotas, you don't have that freedom. So I think commission quotas are the problem, not necessarily products and pricing structure and commissions on individual products. But all that I was required to do was ensure that my recommendations were not unsuitable according to the client's investment risk tolerance and plans for their money. So if someone was not that willing to take risks, and I put them into what we call the BRIC fund, that's Brazil, Russia, India, and China. A little more volatility, it's completely international. If I put them there, that was ignoring the fact that that would not be suitable for them. So if I did that, that would be an unsuitable recommendation. I always made suitable recommendations. I just can't predict the market. I would rather, as an advisor, to advise clients, I'd rather be in a position to turn down business that doesn't fit than feel pressured to always meet a quota every month. I think this is the last page of lessons learned. Do not invest in securities until you have secured a minimum amount of lifetime retirement income that you and your spouse cannot outlive. Basically, the word investment is code for can lose value. Don't put your money at risk until you've secured at least a minimum amount of lifetime retirement income, at least to the amount to meet your basic living expenses. Then, if you wish to play the market, you can do so with the remaining balances you have. Go for it. That's not exactly what I would recommend, nor is it something that I would help you facilitate because I am not licensed in that area. Now, there are some other investment strategies out there. There's something called fund of funds. Now, what's that? This is referencing Franklin Templeton's founding funds allocation. It's actually 3 mutual funds in one, and they have it allocated a third, a third, and a third. So if you put in $1, you have 33 cents in each available fund. And then every quarter it rebalances. So if one fund grows to 38%, they're going to sell off the excess and put it into the other funds, and we're going to restore the allocation every quarter, which sounds great. You're going to be selling high and buying low. That's the idea. So rebalances quarterly, sell high and buy low, but they have higher costs. And it still does not guarantee against loss. Just because you have a good allocation does not mean that you are protected against investment risk and loss. So if the entire market tanks, as we saw, your rebound still won't be as good. There's also something called tactical wealth management. This is available through registered investment advisory firms. There's still no guarantees, and there are higher costs. You're looking at between 1.75 to 2.25 all in, which includes the fee to the advisor you're working with as well as to the third-party asset managers. These costs never go away for the life of the relationship. So I want you to think about this. Over 10 years, you're paying out about 17.5 to 22.5 of your original balance. So if you're starting off with $100,000, just to keep the math easy, that's $17,500 to $22,500 over the next 10 years. And that's almost regardless of what the returns are. So if you got zero return, you're still paying out those fees just so you can have tactical wealth management. Now, typically, to have those services, it requires a higher minimum asset or relationship requirement. So it's typically $100,000 minimum per money manager. Some may be lower, some are higher, but you have to have the relationship that makes it worth it for the advisor and for the firm. So if you only have $50,000, that's generally not going to be a suitable recommendation for you. So in short, I'm done playing the game. I don't like playing the game. If I cannot bring peace of mind and security to someone's financial situation, why am I doing it? Real financial planning is about helping people to do a better job of spending, saving, investing, insuring, and planning for financial independence and peace of mind. But if I'm increasing risks in my client's financial situation, then I'm not a financial planner or carrying out the true role of what financial planning is all about. But you don't necessarily want to keep your money in the bank either. Bank rates have steadily and steeply declined. You're really lucky if you find anything over 1% today. Bank savings and CD rates, they just don't keep up with inflation. I suppose there is a silver lining to that, which is that with low earnings, you really don't have to worry about taxes on your interest. You know, in this case, I really would rather worry about taxes on my interest. I want better rates, but they're not there. So with keeping all that in mind, so I've shown you how I used to think about investment allocation, how I made those decisions, how the market is still completely unpredictable. What is a possible solution? I do have one that may or may not fit your situation, because everybody's situation is different. It does offer principal guarantees. You'll see the asterisk there. This is subject to the claims paying ability of the issuing insurance company. This is through insurance. These solutions can capture reasonable upside without the downside risks. For example, if the market does, on the up year is a positive 10 and the down year is negative 10, then this strategy may get you 7% and not lose anything. Now that's an example only. These rates can and do change. It will not represent any particular product, but that's in general how they work. It's ideal for creating income streams in retirement. So it's good for 401k balances, 403b, IRA, Roth IRA, other kinds of accounts meant for retirement income. And of course, more terms and conditions apply. This is not meant to tell you about how it works. This is just meant to say this is the highlights of what it can do that may or may not fit your situation. Now let's talk about the value of indexing. Let's assume you have $100,000 invested in the stock market. And if the market goes up 10%, how much do you have? You have 110. If the market goes down 10%, now how much do you have? You have 99,000. So we ate away just a little bit in principal. And if the next year goes up 10%, how much do you have? Well, we're going up 10% from the 99, so we're at 108,900. If the next year goes up another 10%, how much do you have? You've got 119,790. And in general, isn't this about how the stock market works? Well, without going through a live exercise yet, that's about how it works. That's how we think of the market. So let's suppose that you have the same 100,000 saved in a principal protected asset. And if the market goes up 10 and you only get 7, how much do you have? You have 107. If the next year the market goes down 10, but you only get 0, how much do you have? You have the same 107,000. The next year goes up 10, but you only get 7, you get 114. Next year goes up 10 and you only get 7, how much do you have? You get 122. Well, before it was 119, so you're just a little bit better off because you're avoiding the losses. So to me, this one makes more sense. We're looking at building wealth long term, not just trying to chase investment returns. So let's do a comparison. I did this some time ago. This is a 5-year, maybe 6-year comparison because we're looking at the full year 2008 through the full year of 2013. Let's compare the S&P 500 to generally a fixed indexed annuity. You started with 100,000. 2008, we lost 40%. The indexed annuity gained nothing, but didn't lose anything either. The next year we gained, and we gained, and we gained, and we gained, and we gained. We can see the end results. The S&P 500 was you left at 125, whereas the annuity had 131. The annuity is not as sexy, yet you have a higher potential gain. And that's based on the S&P 500 returns and a sample gain cap, and that stayed consistent the entire time. They can and do fluctuate. But if the market goes up 10%, how much of that did you actually get? Because aren't there portfolio management fees? We talked about that a little bit earlier. So let's redo this with portfolio fees. We're going to assume 2%. We're going to be moderate on that. So we've adjusted everything to reflect the 2% fees. But notice in 2011, we used to have a positive 1%. Now we have a negative 1%. The fees ate up your gain. So now with the fees being factored in of just 2% affecting the returns, the difference is even greater, assuming that everything stayed the same. So avoiding the losses and keeping continuous uninterrupted growth will help you with your financial development far more than trying to chase a great story of a fantastic return. So do my services and solutions apply to you? Contact me. Let's do a case study analysis. I work with residents here in California. We can do a web conference meeting and we can look at your situation using the software, and we can take a look and see where can we bring some more safety, security, and guarantees into your situation, and if it makes sense for your situation. Sometimes it doesn't make sense. I'm looking to make the right recommendations, not just to try to make a sale at every time. So let's see if we can get together, let's talk, and let's find out if I can be of great service to you.